Corporate finance practice problem using OneNote. Payback period, time value of money limitation. Get ready, it's time to take your chance with corporate finance. Here we are in OneNote. If you have access to OneNote, would like to follow along, you're not required to, but if would like to, we're in the icon left-hand side. We're in the practice problems down in the 1219 payback period time value of money limitation tab. Also note when using OneNote, take a look at the immersive reader. Our presentation's up top, mirrored down here in the text area. The text area having the same name, same number in them, transcripts that can be translated into multiple different languages and either listened to or read in them. Closing out the icon up top, we're going to have our information up top, calculations down below. Information for the payback period. Remembering, as we look at the payback period, we're thinking about a project that's going to be a long-term type of project. General scenario, we have a lump sum payment being put in up front. We're going to get a return on it, typically multiple years into the future. Our question, when are we going to get paid back? Limitations of the payback period, often emphasized by book problems. They don't include the time value of money involved in it, and they don't even really take into consideration the gross profit at all, although we probably have an idea of that when we do the payback period. And those will often be emphasized in a book problem. Doesn't mean payback period's bad, good calculation, but got to know the limitations. Those limitations are often emphasized in a book problem. So here we have the initial investment of the $160,000. That's how much we're going to put down. We're going to project out the cash flows into the future in two different projects or products or something we're going to put money into. It might be machinery. In practice, it could be equipment, it could be a project, it could be products that we're going to be purchasing that we then expect to return in the future on. Any of those scenarios would be it. If you have a lump sum in the beginning so that you can get money later, that's the typical scenario. So we have 1, 2, 3, and 4 years out. We got the first scenario X and then Y for product 1 and product 2. You'll see they have the same number of years here, which means it's usually pretty better for the payback period if they have a similar number of years that are going to be paid back, as well as a similar kind of investment that is taking place. But you can see that the mix between the two is kind of unusual. Like period 1, 70,000, and then period 2, 40, 40, and then 30. Whereas Y, you have the 40, 40, and then 70 and 30. Now, just by looking at that, if you're doing a book problem, you might be starting to say to yourself, maybe the book problem is going to try to emphasize the fact that this 70,000 right there is greater than this 70,000 over here if you take into consideration the time value of money, even though the total payments themselves could be the same. And that's what I would assume to kind of happen. So if it was a book problem, right? In practice, the fact that the payback period will often, if the same investment goes in place and the length of the payments are similar, the payback period will often come out with a similar result as the time value of money, because you'll get paid back sooner if you get paid back earlier. But there could be unusual circumstances there. So in any case, if we just looked at the total profit here, if we were to add these up, 70,000, I'll just say 40 plus 40 plus 30, right? That's the 180 minus the 160. That means we got a 20,000 profit for X. And we get the same thing with Y, 40 plus 70 plus 30. Is 180 minus the 160. We get the 20,000 for the profit on either scenario. That's not something we would know from simply the payback period, but it's probably something that we would quickly calculate and then calculate the payback period, right? We'd probably be able to say, okay, that's the money, then payback period. But these calculations down here do not take into consideration the time value of money. And once again, just looking at this, I'd say, that's 70,000 that I get paid up front. It would be nicer. I'd rather get paid in the first year the 70,000 versus the 40,000, which is kind of what the payback period measures, but we still could come up with a situation where the payback period doesn't quite pay us, back in the same time period. So let's see how it works out here. Payback period. We're going to do product 1, first scenario. Investment, 160,000. That's how much we're going to put down. Then we're going to get this series of payments that we expect to be happening. We're projecting out into the future. That's what we hope we get, or that's the plan. 160,000 then, 160 minus what we get in period 1. And just remember, this is how you want to set up the table, whether you do this by hand or by Excel or anything like that. You got to set up your table and have over here, okay, there's the 160. You might represent it as a negative number, the outflow, the amount that we need to get paid back. and then I'm going to say minus the 70. That means we still got to get paid back 90,000. What happens in year 2? We get 40,000. So if I take that 90 minus the 40,000, we're going to get 50,000 that we still have not yet paid back. And then in year 3, another 40,000. So minus another 40. That's going to get us to 10,000. And finally, in year 4, we get cleared in the 30,000. That's our $20,000 profit. Our focus isn't on the $20,000 profit for the payback period specifically. Our focus is that we got paid back our $160,000 investment, not including time value of money, sometime between year 2, 3, and 4. Next question is when, how much of a fraction of a year did we get paid back in? Typically, the calculation for that is to take the amount still needed after the year right before we got paid back, 10,000, divide it by the 30,000, the amount that we received in year 4, imagining we received it evenly over that year. So scrolling down, it'll look like this. 10,000 over the 30,000, that'll give us the 0.33. 10,000 divided by the 30,000. 0.333 on forever, about 0.333. Remember, a test question could ask you that in terms of a decimal. They may ask you in terms of days. So you could take 360, which is 12 times 30, about 360 days in a year, times 0.33 on forever, and you get about 118 days. If I took that and divided by 30 days in a month, we get about 3.96 months, almost 4 months. Or you take 12 months times 0.33, and you get about 3.96 months. And so that means that the payback period is 3 years, 0.33, 3.33. That's our payback period. You could also calculate it with a running balance down here just to get an idea of this fraction. For example, if you took 100 and 360 days in a year and listed them out and assumed that you're going to receive this 30,000 evenly over that time period, 30,000 divided by 360, then the question is, when do we get to that $10,000 amount? So we can just add this up in a running balance calculation. We could say, all right, it starts out at 83, and then in period 2, we get another 83, and then plus another 83, and so on, plus another 83 each period. When are we going to hit the 10,000? Let's check it out. If we did that all the way down here, which is easy to do in Excel, difficult if you didn't have Excel, but just for conceptual purposes, down here on day 120, we hit the 10,000. Anything above that day is profit. So that's it. That's the payback period. Payback has been achieved. So that means 120 divided by 360 is 0.333, which is exactly, of course, what we got up top here. All right. So now let's do it for the second project. Project Y. Why? Because that's what we're doing here. That's how so we got the 40, 40, 70, 30. Same thing. Same 160. That's our initial investment. We're going to get paid back in year 1, 40,000. So we're going to set up our table here with our 3 columns and say, all right, year 1, 40,000. We're going to pick up the 160,000 minus 40,000. We get 120 still not paid back. We're taking that 120 minus what we get in year 2, another 40,000 minus 40,000. We're left with 80,000 still not paid back. In year 3, we're going to get another 70,000. So minus 70,000. We're still not paid back. And then finally, we're going to get the 30,000, which pays us back. Once again, we have the same profit that we had for the first one, that 20,000. And we still have that 10,000. We're left in basically the same place, you'll notice here. Isn't that strange? So it almost looks like it was planned this way. So in any case, we have the 10,000 that we still need to recover, and we usually take the fraction of the year, that 10,000 divided by the amount that we get in the following year, the 30,000, looking like this. We get the 10,000 over the 30,000 is once again 0.33. So the result then is 3.33 again. So both of these come up to the same 3.33. So the question then, test question, or this is what the analysis would be. If you use the payback period, which one would you choose between the two if you can only pick one of them? And the answer is, I don't know, because they're both coming out to 3.33, and I would usually pick the smaller one because I'd want to get paid back sooner. but they're both like totally the same. And then the question is going to be, well, does that make sense? I mean, are these both completely equal in nature? And you're gonna say, no, not really, because that 70,000 right there, although we get paid back in the same time period, that 70,000 right there is, you would think, would cause this one to be worth more because that has a greater time value of money than this 70,000 we got down here. It just so happens that they happen to add up now to the same payback period. But if I applied the time value of money using the net present value or internal rate of return method, I would assume that X would be higher than Y. So in these two cases, we see that even though the net income is the same without time value of money considered, and even though they have the same number of periods, it is possible to have the payback period be the same and yet one be worth more due to time value of money, which we would see if we did a time value of money calculation. Note, however, this one has to be constructed a little bit weird in order to get that, because usually if you have the same investment and the same series of payback periods, the one that gets paid back faster, meaning if you got paid back sooner, would also have a lower payback period and would be better for the time value of money. It just so happens that the way this was set up was more unusual in that the 70,000 and 70,000 down here, fell into the same 3.33 year time period, even though they were different within that time period. So it can happen. It might not always happen, but that's what you'd expect to see, kind of like in a book problem, because the book problem is trying to emphasize the fact that although these look very similar, and although we're using the payback period and they come out to the same number, and although the net income is the same between both of them, if we don't take into consider time value of money, when we do consider time value of money, one will most likely come out to be better. And we'll look at more scenarios like that in the future when we use time value of money calculation, which will include the net present value calculations and the internal rate of return, the internal rate of return or IRR calculation.